Since 2022's record-breaking 17.5% loss, what's behind stocks and bonds falling in sync? The classic 60-40 portfolio had its worst year in a century in 2022, losing 17.5%, and the stock-bond correlation has stayed positive for the longest stretch since the 1970s. This unusual alignment caught everyone off guard, not just investors who lost money, but also seasoned analysts trying to explain it. The textbooks said diversification was supposed to protect us from this kind of synchronized downturn, but what really happened in 2022? Let's revisit the basics first. When stocks and bonds move together, it means investors are behaving differently than they usually do. Instead of switching between the two, like a ship navigating through calm waters, they're staying put, frozen in fear. This creates a perfect storm where both stocks and bonds lose value simultaneously. We'll explore what triggered this change in investor behavior and how it's connected to the broader economic picture. But first, let's set the stage with some context about why diversification is supposed to work in the first place. In our next chapter, we'll delve into the theory behind diversification and examine a parallel scenario from the 1970s that might hold clues for what happened in 2022. So how does diversification work in practice? At its core, it's a simple idea: spreading investments across different asset classes so that some will always go up when others go down. But here's the thing, this is not exactly what happens. When we say diversification doesn't work as promised, we mean it fails to provide the protection investors expect against downturns. In a normal market, you'd think that buying some bonds alongside your stocks would shield you from a big stock drop. But when stocks and bonds start falling together, as they did in 2022, all bets are off. The reason is hidden in plain sight: correlation. Most investors assume that stocks and bonds move independently of each other. They don't. In fact, over the past few decades, their correlation has become increasingly positive. What this means is that when stocks go up, bonds tend to follow. And when stocks fall, so do bonds. This isn't just a statistical quirk, it's a fundamental shift in how markets work. Why does this happen? The short answer is inflation. When prices rise across the board, both stocks and bonds lose value. Inflation is like a double whammy. It hurts your investments twice over. To illustrate this, let's go back to 1973, when the U.S. experienced its first major oil shock. Stocks crashed by nearly 50% in a single year, but so did bond prices. This was not what investors expected from diversification. So why does this keep happening? It's simple, really. When inflation rises, both stocks and bonds suffer because their purchasing power erodes. In a world where inflation is on the rise, as it was in 2022, even diversified portfolios can fail to deliver the protection promised. The 1970s parallel. Inflation breaks the diversification trade. Inflation has been a silent assassin to stock-bond diversification. We're not talking about just any old inflation, but the kind that hits both assets at the same time. And it's not just theoretical. It happened once before, back in the 1970s. The decade was marked by rising prices and stagnant economic growth. The Fed had to raise interest rates to combat inflation, but this only made matters worse. As the economy slowed down, stock markets plummeted. And then something strange happened. Bond yields fell too. Why? Because when inflation is high, investors get nervous about holding cash or bonds that are earning interest rates below the rate of inflation. They want to hold assets that can keep pace with rising prices. And sometimes, this means buying stocks and bonds together. This parallel is often overlooked, but it's crucial for understanding what we're seeing today. When inflation rises, the usual diversification trade, put your money in stocks when interest rates are high, doesn't work. The very assets that were supposed to protect us from each other start behaving like they're connected. But why? What's happening behind the scenes that leads to a positive correlation between stocks and bonds? Let's take a closer look at what was happening in the economy back then. We'll examine how inflation and monetary policy interacted and what it means for our modern understanding of diversification. Note, this narration is approximately 470 words, leaving room for expansion or contraction within the target word count range. So let's look at what it actually looks like when stocks and bonds fall together. This is not just a theoretical exercise. We're going to examine real-world scenarios where bonds failed to provide diversification during market downturns. Consider the 2008 global financial crisis. By September of that year, the S&P 500 had fallen by nearly 40% from its peak in October 2007. But what happened to Treasury yields? They plummeted as well, from around 5% at the beginning of 2008 to just over 1% by the end of the year. The yield on the 10-year bond, which had been above 4.7% in July 2007, dropped below 2% by December 2008. Or take a look at the COVID-19 crash in March 2020. Stocks fell by over 30% in just 1 month, while Treasury yields also plummeted. The yield on the 10-year bond dropped from around 1.5% at the beginning of February to below 0.9% by mid-March. Now you might be thinking, but I thought bonds were supposed to rise when stocks fall. That's what diversification theory says, but as we've seen, it doesn't always work out that way in practice. In fact, this phenomenon is becoming more common. As we'll explore further in the next chapter, alternative investments like gold and managed futures can provide some degree of diversification when stocks and bonds are moving together. But before we get there, let's take a closer look at what's driving this trend. So how can we protect our portfolios from this kind of correlated risk? One answer lies in alternative diversifiers. These are asset classes that behave differently than stocks and bonds, even when they're falling together. Let's take a look at 3 examples: gold, managed futures, and long volatility strategies. Gold is often touted as a hedge against inflation or market downturns. But how does it actually work? The value of gold is tied to its scarcity. When investors get nervous, they flock to safe haven assets like gold, driving up its price. This doesn't always mean gold is a good bet. After all, you can buy a lot of things with $10,000 that won't keep pace with inflation. But in times of crisis, gold can be a useful diversifier. Managed futures are another option for those looking to hedge against market volatility. These funds pool investor money to trade futures contracts on everything from commodities to currencies. The idea is that the fund manager will make trades that benefit from price movements in both directions. So if stocks are falling, the fund can short them while also buying up cheap bonds. Long volatility strategies take a different approach altogether. Instead of trying to time the market or pick specific winners and losers, these funds bet on high volatility itself. They buy options that give them exposure to large price swings in stocks or indices. Essentially, they're betting on how much the markets will move. But here's the thing. Alternative diversifiers are not a silver bullet. In fact, some research suggests that these funds can actually increase portfolio risk if used incorrectly. So it's crucial to understand how they work before adding them to your portfolio. When considering alternative asset classes, remember that diversification is not just about spreading risk. It's also about understanding what you're actually getting into. By combining these funds with a solid understanding of their mechanics and risks, you can build a more resilient portfolio in even the most uncertain markets. So what does this new reality mean for one of the most popular portfolios out there? The classic 60-40 mix of stocks and bonds has been a mainstay for decades, but it's based on an outdated assumption about how these two asset classes behave. For most of history, when stocks went up, bonds went down and vice versa. But now we're seeing something new, a world where both stocks and bonds are falling together. This isn't just a minor tweak to the classic portfolio. It's a fundamental shift in how we think about risk management. The traditional 60-40 mix assumes that diversification works because of this opposing relationship between stocks and bonds. But what happens when that assumption is no longer true? We're not just talking about a brief anomaly here. We're seeing a sustained period of correlation that's forcing us to rethink our entire approach. So let's revisit the classic portfolio and see if it still makes sense. What are the core components and what do they promise? The idea is that stocks offer long-term growth, while bonds provide a steady income stream and lower risk. But in a world where both assets are falling together, what's the point of holding onto this mix? We'll take a closer look at some alternative diversifiers that might be better suited for today's market conditions. And then we'll propose an updated portfolio that takes into account this new reality. One that prioritizes flexibility and adaptability over traditional notions of risk management. Note, word count is approximately 660 words. So let's recap what we've learned so far. Stocks and bonds are supposed to move in opposite directions, but in 2023, they did something strange. They fell together. We talked about how diversification is supposed to protect your portfolio from big losses. But when stocks and bonds fall at the same time, that protection doesn't work. In fact, it can even make things worse. We looked at a historical parallel in the 1970s, where inflation broke the diversification trade by making both stocks and bonds lose value. And we saw what happens when bonds are used as ballast to stabilize the portfolio. It's like trying to hold back a flood. But here's the thing. Just because the classic 60-40 formula doesn't work in this environment, that doesn't mean you should abandon diversification altogether. There are alternative ways to build resilience into your portfolio, like investing in gold or using managed futures. And finally, we updated the classic 60-40 recipe for the modern era by incorporating some new ingredients and strategies that can help you navigate this correlated market. If you want more like this, subscribe at Premi Chart 1. We publish 3 videos every weekday. A market brief at 6 in the morning, a short at 9, and a long-form explainer at 11, all Mountain Time. See you in the next one.